look, I've never been able to call it top. That's a fool's game.
Let's say everybody piles in at 100 and it keeps going to 200. You just got wiped out if you are selling
that's
short.
a fool's game. You never short while it's going up. Never. That is a recipe for putting your fund out of business. You have to wait until the chinks are evident to the longs. You cannot anticipate the chinks. You'll be right once and wiped out 4 times.
What's up, everybody? Michael Silva here to do some technical analysis on the S&P 500. The video that you just watched right there at the intro was Jim Cramer and James Altucher talking about how to trade a short squeeze. The full interview is in the link in the description below. I found that video to be relevant for what's taking place today. In today's video, what we're going to be looking at is the daily time frame and the 30-minute time frame. We're going to map out supports, resistance, talk about a few patterns, and also bring in a few indicators. Now, in yesterday's video, we talked about this megaphone pattern taking place here on the daily time frame, and I want to just touch on a few more things that are taking place within this pattern. The first thing that I want to do is just call out another record in the S&P 500, monster day, up over a percentage point, closing at a record high of $3,478.74. Now, what I want to call out is, when can this thing potentially start turning around? Can this market push us to the top of this trend line? And how much further would that necessarily be? Well, we have a tool right here to measure it. So we're going to go ahead and go from here to the top of that trend line, and it puts us at about 2% more to the upside. Can it break past that? Yes, it can. However, it does look like a strong area of resistance. So if we keep getting pushed more and more to the upwards direction of this trend line, I would expect to see somewhat hesitation at that specific level. That places the S&P 500 right around 3,500 to 3,600, so keep an eye out for those ranges. As I stated in previous videos, the S&P 500 is at a 15-year low for short interests. Can we make it to the top of this trend line? It's looking more and more possible as these days go by, but we'll have to see and play it day by day. The next thing that I want to call out is this huge overextended move from the 200 period moving average. When things get very overextended like this, it's very likely to see snapbacks. So as you can see right here, 400, maybe just a little bit more than 400 points off the 200 period moving average. That's almost 14% above that. The last time it did that was over here. And as you can see, that was only 12% at 364 points. When you look back in history, here's one right here. Let's measure that out. That was 350 points as well. So 350 points, and we got a snapback. 350 points, we got a snapback. Now we're at 407 points, which actually is an all-time record high. As you can see right here, boom, the S&P 500 index has never been this extended versus its 200-day moving average in history. This big short squeeze might be in anticipation for what Federal Reserve Jerome Powell might be coming out tomorrow and say. It's expectations out there saying that he's going to be keeping rates near zero for the next 5 years. So dovish talk is expected to come from the Fed. There's also expectations around him talking about inflation and how to meet their targets and or exceed their targets. To me, it sounds like he's willing to let inflation run very hot, which printing money is the definition of inflation, the expansion of the money supply. The more money you print, the more inflation takes place. Now, we're not seeing it in goods and services right now, but we definitely are seeing inflation in certain asset classes. And those asset classes happen to be the stock market. But who is really benefiting from this? Well, if you heard of the wealth inequality gap, this chart right here represents that the richest 1% own 50% of stocks held by American households. The chart here shows to 2016, so if we can get an updated chart on this, I can guarantee you that that wealth gap has expanded. Now, I don't necessarily have a problem with the wealthier getting wealthier. They became wealthy because they took risks. They created employment for other individuals. However, what I do have a problem with that bugs me is when the Federal Reserve comes in to save the day or save companies that should just go bankrupt. not just the Federal Reserve, but also poor government policy as well. For example, American Airlines is here to cut 19,000 jobs by October 1st when federal stimulus ends. It was a temporary fix, also known as kicking a can down the darn road. So the wealthier, they get wealthier. The people that are struggling continue to struggle as there's a huge disconnect between assets in the stock market and the real economy. All right, so this right here is a rising wedge pattern that we've been talking about. And hello, peekaboo, it's popping itself out. And we talked about this yesterday, saying it looks like it could potentially just get squeezed more to the upside and potentially here hit into this trend line, this upper trend line for the Megaphone Pattern, which would put it at darn near 35 to 3,600, that specific range. This right here is darn near a complete vertical move in the index. We're seeing very similar things take place in the NASDAQ 100 as well, and other individual stocks, mainly tech stocks. Now these indicators down here, I want to quickly go over. This right here is a McClellan oscillator, and really what this is saying is the market breadth is below zero, which means there's a negative divergence. As we're seeing these markets move higher and higher, many other stocks are struggling to reach all-time highs. The next indicator here is known as the VAPI, the Volume Accumulation Percentage Indicator, and this was developed by Lazy Bear. In a previous video, I told you how to get a hold of this script so you can use it as well. It's really good for tracking divergences. And what I'm seeing take place right now is a divergence. As you can see, right here was a high and we're moving down to a lower high. And if we go to the same place on the price action, we're right from here, a low high to a higher high. So we're really seeing a divergence start to spread bigger and bigger taking place. These moves that are happening on not the highest of volume. And this is very dangerous in these type of zones, because when we have down days, that's typically when volume can really start picking up, which means we're taking the staircases up and the elevator is preparing itself for a down move. How high can this go? I'm not too sure, but as Jim Cramer said, don't short a market that's running hot. This right down here is known as the Relative Strength Index, and as you can see, we are reaching a real high right here at 76.92, meaning that these stocks are completely overbought. Now, what I want you to know about the Relative Strength Index is stocks can remain overbought for quite some time. Now, a lot of the tech stocks are really what's driving this market and propelling it forward, while other stocks have not reached all-time highs, so there's room in these other stocks to move, which is really kind of throwing these indicators out of whack. Now, that doesn't take away from the narrative that the overall market is overbought, but you need to understand somewhat the underlying causes of everything. So the short squeeze is still continuing. When will we see it pull back? Well, it's anybody's guess. I'm thinking that we're going to probably reach the upper portion of this trend line given today's powerful move, yesterday's powerful move, the day before's power move, and pretty much all of August's powerful moves. Let's go ahead and take a look at what the VIX is doing right now. All right, so we are here looking at the VIX, the volatility index of the SP 500. And I want to point out that it did break out of this and it's kind of riding this trend line, going kind of sideways. If you take note of the S&P 500, despite it making new highs, we're keeping high right here as well on the VIX. So the VIX is at this positive divergence right now. Now, we had a big green day on the VIX today and the S&P 500 went up as well. Typically what you see is when volatility increases, you can typically see the S&P 500 pull back. Now, since the breakout, it obviously has held. And like I said, I still think that it has the potential of pulling back and filling this gap, but we're going to have to make sure that we monitor this because the volatility, when it picks up, we can see some extreme moves as you've seen in the past, like here, and then also back here in February, where the spike ups really did happen in a blink of an eye. If we see a break above this 24 to 25 right there, that would suggest to me that we're going to see some more increases to the upside to ultimately hit that target on the VIX of right around 40 to the high of about 45, that range. Now let's go ahead and hop over to the 30-minute time frame to map out some support and resistance for tomorrow's trading day. All right, we are here at the 30-minute time frame. This blue vertical line going down the screen represents where the day started. We have the red and green lines. Those are areas of resistance that we mapped out yesterday. And the green lines were areas of support. Now, I've been saying buy the dip, sell the rip. And at the end of the videos, we talk about some type of trade plan. And the trade plans that we marked out, one of them, or the second one that we discussed on yesterday's video, was if we did have a gap up, look for the window to be filled and then buy in with the tight stop loss and capture the ride to the upside. Now, I said that about this support and also this support being one of my more favorites. However, the only test of support that we got was when this resistance was broken and then we had the pullback. So if you managed to watch this 30-minute time frame, you would have seen the gap up, you would have waited for the pullback, and then you would have had a tight stop loss. And look at that thing run for approximately 3 hours straight up to the upside. Now, the next area of resistance that we talked about was this trend line right here. And you can kind of see it got a little rejected, but ultimately broke through, then it back tested it again, went higher, back tested it again, and then bounced again from that area. So this trend line clearly held up as an area of support after it acted as somewhat of a resistance. So now what we need to do is map out our new areas of support and resistance going into tomorrow. Now this one down here is probably not relevant. I mean, it is an area of support, but the price action is pretty darn far away. So what I want to do is move this level up to right here as our first area of support. That's going to be 34.65. Why is that? It was tested on 3 separate occasions, even with some huge candle movements right here. So the bears really stepped in and the bulls fought right back up to the top. So the first level of support is going to be right there. The next area of support is going to be right here at 34.72. And the reason there is because clearly it acted as a level of resistance and then support for this specific candle. So we have a couple areas of support going into tomorrow. A level of resistance is going to be right here again at the all-time high. That's 34.80 or 34.81, whatever you want to call it. We'll call it 34.80. But clearly that was an area of resistance for 2 hours right here as it struggled to get above that price. So now let's talk about some trade plan ideas. One thing I'd like to mention is I'm not really looking to short this market at this particular point in time. If you would have seen this big red candle, as I mentioned on my Instagram, it was a very powerful flush to the downside. I said that, hey, this looks like a good bounce opportunity on the 30-minute time frame, or I was using the 5-minute time frame. And if you played that trade, you would have captured a little bit of profits, but it forced itself down more. And that didn't necessarily scare me because the overall context of the chart is still bullish. Now, when it came back into this level, clearly the bulls, like I said, stepped in and wow, that thing was just an ultimate run. And that was right around the 50-period moving average on the 5-minute time frame when that actually took place. Now, when I put up the 50-period moving average, clearly it is far down there. So we have a very overextended move from the 50-period moving average, meaning that the price action is above it. This means this is going to continue to move higher and higher throughout the next trading days. Now, can we get a snapback? Yes, of course we can get a snapback. So you got to be careful and have your stop losses in place. So what can we do for trade plans? Well, it really is the same thing that we said yesterday. If we have a gap up, look for a window to be filled and then have a tight stop loss and then play the bounce to the upside. If it comes down to this support level, do the same exact thing. You can buy in and have a tight stop loss, maybe even potentially under the rising wedge trend line right here. And then you ultimately also have this one at 34.65. You can buy in on the dip and have a tight stop loss. If it keeps continuing to move down to the downside, you can look for other specific areas, but really there's a lot of air within this move to the upside. So there's not too much data points as far as resistance and support goes. So you're going to have to do your best to find that out on smaller time frames if that were to take place. As far as the 30-minute time frame goes, these are the levels that I'll be keeping an eye on going into tomorrow. That's all I have for you on today's S&P 500 technical analysis update. I'll see you back tomorrow.